All right, good evening, Abidemi. Um, so we're going to continue from where we stopped in the last class. So we have decided to go back to simple consolidation before we make an entry into complex consolidation. As you already know, this class is focused on group accounts. Before we will do maybe 4 standards that I've already mentioned when we started the class. So we're going to go back. We'll try and pick up pace as much as we can, and then we'll make an entry into complex consolidation. However, it is important that you pay attention, especially for many of us who have reached out at one point or the other, that it will be better for us to, take consolidation from the scratch and build it up. If you find me a bit fast, it's probably because I am assuming that that aspect is an aspect that we already are grounded on. Okay. So we're going to get started. I want to believe you can see my screen that I'm sharing. Please give me a moment. Just a moment. Offer. Okay. No, I go set you. Okay. Let's continue. Okay, the last question we solved last week, I think it was a question that had to do with goodwill and NCI and post-acquisition retained earnings. So a quick recap of what the major procedures that we have been using have been is that, number one, when you're consolidating, you are adding up or you are summing up line by line items of the parent and the subsidiary. However, you must also remember that in a consolidated financial statement, we are assuming that both the group, the NCI, and the subsidiary are assumed to be one entity. And as a result of that, we said we're going to cancel out the investment of the parent and the NCI against the net assets of the subsidiary that was acquired. That is the principle of cancellation. As a matter of fact, I said there are 2 principles. You are summing up and then you are canceling any transaction that takes place between the parent and the subsidiary. So in this class, we have seen how the transaction that took place at the point of acquisition is being treated, leading to goodwill. We have also seen that whenever you have a current asset in the book of the parent and the same amount is in the book of the subsidiary under current liabilities, which is as a result of trading in between the 2 companies, what you're going to do is that you're going to cancel out, right? Now, in this class, we're going to see another situation whereby there is trading between the company, the parent rather, and the subsidiary. And then you have such inventory still in the books of the parents, and then you also have a case whereby the subsidiary has quoted a price at profit. So that profit should not be part of the consolidation. We're going to have to cancel it out. And we're going to look at that as well as other adjustments that are very necessary. Another thing you must notice, or you would have noticed, is that in all of the considerations that we have given, we see that the purchase consideration that the parent company pays has always been cash. We're going to see other options, other alternatives, such as exchange of shares, and also when there is a contingent or a deferred consideration. All right. Okay. So if you recall what we said, this was the last problem that we solved in the last class, a situation where there is an NCI and there is a post-acquisition retained earnings. Now, why is there emphasis on whether the retained earning is pre-acquisition or post-acquisition? The reason is very simple. It is because the parent company should only have access to sharing in the post-acquisition retained earnings of the subsidiary. Now, the parent will take 100% of the post-acquisition retained earnings if he owns 100% of the subsidiary. However, if he only owns majority, let's say for instance 80%, then the post-acquisition retained earnings will be shared between the parent and the non-controlling interest according to their percentage of holding, meaning the parent will take 80% of the post-acquisition retained earnings, while the NCI would take 20% of the post-acquisition retained earnings. Another thing that we mentioned was that NCI could have been measured at the proportionate share of the net assets acquired, proportionate share, or it could have been measured at fair or full value. Fair or full value. This in itself has its own implication. It has its own implication. And one of the implications it has is what we are going to be considering next, a case whereby there is impairment of goodwill. Okay. Now, according to IFRS 3 business combinations, we are told that according to the standard, whenever there is a goodwill on consolidation, it should be annually reviewed for impairment, meaning that you're supposed to carry out an impairment test annually on goodwill on consolidation. I just want to ask, does anybody has an idea? Maybe you have a line of thought as to why this is mandated. Does anybody want to try? Why do you think the goodwill, the consolidation, goodwill on consolidation is annually tested for impairment? Why do you think that is necessary? You can use the chat box or you can unmute. Does anybody know? Do you want to try? Let me check my chat box in case anybody's saying anything. I don't think anybody's saying anything so far. Okay, I'll move on. Now, you would recall that under normal circumstances, if you remember your IAS 38 that under normal circumstance, you will not see goodwill. You will not see goodwill. You will not see goodwill under assets of any company in their separate financial statements. And this is because goodwill will not meet the definition for what we call under intangible assets. Is not going to be separable. Goodwill will not come into the book until when it can be sold in a separate transaction. So, but when we have business combinations and there is a goodwill, that is a good test to say that yes, this goodwill, we have a company, the parent company, who have paid an amount that is higher than the value of the net assets that they have acquired. And the consideration is that they paid higher simply because they view it that the company that they are acquiring must have grown over the years, and they have a sort of reputation that they are paying a consideration. I don't know if this is understood. So therefore, that is why goodwill will be recognized on consolidation. Now, when it is now recognized, it is now for you to continue to test if the goodwill has not been impaired. If the goodwill has not been impaired, good. But the goodwill is impaired, then you're going to have to make some adjustments. It is those adjustments that we're going to consider now. Give me a moment. I just got. All right, let us continue. So we're going to look at a case where goodwill is impaired. What is the implication and how do we go about it? Okay. So let's look at impairment of goodwill. All right. We are told PICO acquired 75% of the ordinary shares of ESCO on 1st January 2017. When ESCO had retained earnings of 7,500, PICO values NCI at proportionate share of subsidiaries' net assets. Goodwill is impaired by 20%. Now, statement of financial position as of this date, 31st December 2017, were given below. You were asked to prepare consolidated statement of financial position of PICO at 31st December 2017. Okay, what are the issues that I itemized that we need to first of all deal with? The issues I said we should first of all deal with are, first of all, what is the group structure? Now, the group structure is such that PICO owns the subsidiary ESCO by only 75%. Therefore, NCI owns the remaining 25%. All right. Now, if this is the case, PICO definitely is in control, right? They have control. Therefore, PICO has the responsibility to consolidate the affairs of the entire group. Abi? Now, if that be the case, what's the next thing? The first thing on the agenda is to cancel out the investment of PICO in ESCO. Now, that cancellation this time around would include the NCI, because like I made mention of, I will repeat myself, we will treat even the NCI as part of the group. The only difference is that the NCI will show up as a component of equity on the consolidated financial position as a separate line under equity. It will show there. Okay, now let's do it. I would say goodwill. Goodwill, we all know, would only take place when you have a higher consideration than the net asset of the subsidiary. But let's go. Purchase consideration of the parent must have been 34,000. NCI. Now, what did they tell us about NCI in terms of valuation? They said it is proportionate share of subsidiary net assets. Okay, now what was the net asset that was acquired? The net asset that was acquired, 25. NCI will own only 25% of the 25,000 ordinary shares. But don't forget that the question mentioned to us that EBSCO had a retained earnings of 7,500 as at this date. Okay, so a simple calculation to do here would be to say 25% of 25,000 plus 7,500. Okay, why am I adding 7,500? As at the date of acquisition, EBSCO had that retained earnings, which will form part of their net assets that was acquired. Okay, so a quick math there. You do 25. Can somebody help me? 25% of 32,500. What do you get? Are we in class? 25%. Are we together? Is everybody in class today? Are we in class today? Is the problem that I'm not being heard? What is the problem? Okay, I'll just go ahead and use the solution. 8125. Okay, now in the calculation of the goodwill, you will see here that what was done was to add that 25,000 plus the pre-acquisition retained earnings of 7,500. That's how they got that 32,500. And when you do 25% of 32,500, you have 8,125. Now, the net assets that was acquired, we have itemized that 32,500, broken it down there. Now, the goodwill on consolidation is 9,625 at the date of acquisition. This was at acquisition date. Now, at consolidation date, acquisition date was 1st January 2017. Consolidation date was 31st 12 2017. So at consolidation date, additional information told us that the goodwill has been impaired by 20%. So I do 20% of the goodwill, I have 1,925. Now, how do I treat this? My double entry for this will simply be impairment should be an expense, isn't it? Impairment should be an expense, but I don't have profit or loss here. What is that item on the financial position that is a representation of the profit or loss. It is retained earnings. So the group retained earnings will be debited, all right, while I'm going to credit the goodwill on consolidation. Why am I doing this? Goodwill is an asset. When you credit an asset, what are you doing? You are reducing the amount of that asset. And what am I supposed to do? From impairment, impairment means there is a reduction in the amount of the goodwill. Now, when I debit retained earnings, I'm saying I'm debiting my P&L, but the representation of my P&L on the financial position is retained earnings. Now, we have also debited the group retained earnings in this case. The simple reason for that is this. Whenever the group policy or the parent's policy is to value NCI at proportionate share, then it means that NCI does not own any part of the goodwill. The NCI does not own any part of the goodwill. So therefore, all of the impairment in goodwill will be debited to group retained earnings. I'm going to see a different case in the next question. I want to believe you have seen how we treated the impairment here. Why is my razor not working? Okay, so the rest is easy. You're just going to see us adding up line by line items. And if there's any other thing that is an adjustment, I don't think there is. Okay, when we come to group retained earnings, we are going to have side by side that which is the PICO and that which is the ESCO. What is instructive that I like to do here is that whatever belongs solely to the group, any adjustment that only affects the group, I'll bring it on this line here. If it is an adjustment that will affect both the group and the NCI, then I'll bring it here, okay? Now, for instance, the post-acquisition retained earnings is to be shared by both the PICO, parent company, and NCI. So our derivation of the post-acquisition retained earnings was still under ESCO. First thing first, what is the retained earnings of PICO? 35,000. What is the retained earning of ESCO? 12,500. However, of this 12,500, only 5,000 is post-acquisition. How did we know that? We took out the pre-acquisition retained earnings. Okay, meaning that this is the 5,000 that we are going to share between PICO and NCI. PICO will get 75%, NCI will get only 25% of this. But there is an adjustment to the profit of PICO, which is the impairment of goodwill. So that adjustment will only be under PICO, all right? Now that will lead us to calculating the share of the post-acquisition retained earnings, giving us 3,750. If you add up this, take out this and this, you're going to get this amount as the group retained earnings, which belongs to the parent. But don't forget that we said for NCI, you calculate NCI, their value at acquisition, and then you add any share of post-acquisition retained earnings. Now, if there are any adjustments that affect NCI, you're also going to make those deductions or additions here. Okay? In this case, no other adjustment other than the share of post-acquisition retained earnings. And then when you come to the solution here, all that has been done, if you look at it line by line, is simply to add up So the first thing first was this addition, making 55,000. And then This was cancelled out. Investment in subsidiary was cancelled out. Current assets was also added line by line. We didn't have any adjustment around it. Not forgetting that goodwill, we had a goodwill on consolidation after we had adjusted it for impairment. So that amount is what you see in the solution here. Goodwill, working 7,700. The current assets were added together like I mentioned earlier. We saw how retained earnings was derived and how NCI was derived as well. And that is that on that. So do we have any questions as regards impairment of goodwill? Okay, if there are none, the next one is a case where NCI is valued by PICO at full or fair value. So in this case, we're going to be giving I have told you you're going to be giving the share price. Now the share price is given to us. Let's read again. PICO acquired 75% of the ordinary shares of ESCO on January 1, 2017, when ESCO had retained earnings of 7,500. The market price of the shares of ESCO just before the date of acquisition was N1.60. PICO values NCI at fair value, and we still have the same situation where goodwill is impaired by 20%. Now pay attention to what I want to show you here. I'll go back to the previous question. Let me show you something there, that just to show you that PICO owned all of the goodwill. How did I know? Okay, PICO transferred 34,000 naira for 75% of the retained earnings of ESCO. Now, those retained earnings, as I said, retained earnings of the net asset of ESCO. Now, those net assets we said is 32,500. If you do 75% of this, what do you get? You get 24,375. Now, if you take out 34,000, if you take out 24,375 from the 34,000 that it paid, you will get an amount 9,625. Now, that 9,625, okay, let me go like this, 34,375. If I do 34,000 minus 24,375, I'm going to get an amount 9,625, which is the goodwill. So it is only the parent who is transferring a consideration that is higher than the net asset acquired. In proportionate share, this 825 is exactly 25% of this. So there is no goodwill that is attributable to NCI. However, in the next question we are going to be looking at, NCI, anytime it is at full or fair value, NCI will own a portion of the goodwill. Okay, now let's look at that. Let's just move on. Since this is just a revision of simple consolidation, let's look at it. Let's see how goodwill was calculated. Now, if you pay attention well, you will see here that NCI, in this case, to calculate NCI, we will say NCI owns 25% of the 25,000 ordinary shares. Now, those shares are trading at N1.60 per share. Therefore, if you do this calculation the same way it was done in the solution, you get 10,000. Okay. Now, the goodwill we have here is an amount, the goodwill we have at acquisition date is an amount 11,500. Now, what we calculated the other time was only 9,625 because it's the same 34,000 naira consideration. Now, what it means is that when I calculate 11,500 minus 9,625, what I get when I do this calculation is an amount 1,875. Now that 1,875, that amount 1,875 is goodwill that is attributable to NCI. So therefore, this impairment of 2,300 is going to be shared between the parent and the NCI. I don't know if you are following. If you have any question, please do not mind to unmute and let me know. How do we treat this? The other time I said we're going to debit group retained earnings and credit goodwill on consolidation. All right? In this case, only 75% of the impairment that is attributable to the parent will affect group retained earnings. The remaining will go specifically to NCI. So we're going to credit NCI. We're going to debit NCI. NCI, don't forget, is a component of the equity. So when I debit NCI, what I'm doing is I am reducing the amount of the NCI, okay? And that is exactly what you're going to see in this case. Let's go to the calculation of group retained earnings. Let's go to the calculation of the group retained earnings. Okay. Now you will see the impairment of goodwill was showing under ESCO. Like I made mention, instructive to note is that what I do is anytime the adjustment is supposed to affect both the parent and the NCI, make sure it is showing here under ESCO. But if it is only going to affect PICO, let it show alone under PICO. Okay. So what did you see us do here? We brought the 2,300 here, all right? So that both, by the time we are sharing the post-acquisition retained earning, it will be an amount that has been adjusted for this goodwill that affects both PICO and ESCO. And at the end of the day, or you can decide to take 75% of 2,300, come and deduct it under PICO, and take 25% of 2,300, come and deduct it under NCI. In that case, the post-acquisition retained earnings of ESCO that you will be sharing will not be 2,700, it would have been this 5,000. You would have realized that if I said 35,000 plus 75% of 5,000 would have been 3,750. And if I did 75% of 2,300, I'll get an amount 1,725. Now, if I come here and I say deduct, and I say deduct 1,725 from this, I am still going to get the same amount as my group retained earnings. So if we do, somebody help me do the maths. 3750 minus 1725. I should get, I think 37025. Is that what we have in the solution? Yes, 37025. That's what we have there. So that is exactly how you can also do it if you don't want to. But rather than do that, those separate workings, if the instruction I have given you or the tip I have given is if it is an adjustment that affects both the parent and the NCI, what you should rather do is to make that adjustment under ESCO, and you will come back to the same numbers rather than doing it separately. Okay, now let's move on. Okay, now what do we do when we have a negative goodwill? It's not called negative goodwill. Instead, it is called gain on bargain purchase. It is called gain on bargain purchase. Now, the guideline that the standard has given us is that when this occurs, you should go back and go back and revalue again, reassess the measurement of both of the identifiable net assets that you have acquired to spot if there are any errors. Okay, let me annotate so that you can understand where I am making reference to. This is what I'm talking about here. Okay, it said in this case, the net assets acquired is higher than the amount transferred by the parent and the value of the NCI. IFRS 3 business combination describes this difference as a gain on bargain purchase. Now, when the cancellation of purchase consideration against net assets acquired results in a gain on bargain purchase, the parent company must, number one, reassess the amount at which it has measured both the cost of combination or consideration transferred and the acquirees, that is the subsidiaries, identifiable net assets. If this exercise should identify any errors, any excess remaining should be recognized immediately in profit or loss. Meaning that the expectation is that there should rather be a goodwill on consolidation. However, if you have so determined and you got a gain on bargain purchase, you have to reassess again. Go back, go and check. If after checking, if you spot errors and even upon still spotting errors, you discover there's still a gain on bargain purchase, that should be immediately treated as profit or loss. Now, that profit will solely be for the parent. You know why? Because it is the parent who has made that bargain. It is the parent who has made that gain on bargain purchase. Okay. Now, let's look at how this was treated here. Okay. Because I want us to move so that we can quickly, finish, maybe in this class, finish whatever we need to consider in terms of, especially in terms of financial position, because I'll move to complex. When I start complex, what is it called now? Consolidation. We'll be starting with financial position. So let's consider everything that we learned under simple consolidation. Now let's look at it. How was this treated? Look at the cancellation of investment in subsidiary versus net assets acquired here. The consideration transferred was 24,000. NCI, we were told that NCI is valued at full or fair value, and as at that day of acquisition, the subsidiaries' shares were quoted at 1 naira 30 kobo. Okay, so you do 25% of the ordinary shares of ESCO multiplied by 1,000. Multiplied by 1 naira 30 kobo, and you get 8,125. Now, the addition of that purchase consideration plus NCI is only 32,125. But when you compare that with the net assets that was acquired at that acquisition date, it was 32,500. Now we have a gain on bargain purchase of 375 naira. Now, since the question is not so different except for the share price and the fact that there is a gain on bargain purchase, I'll just scroll down to how this was treated. You will see that under, let me annotate.
Yeah, it's sure.
Okay, so you see here the 375 was treated under consolidated retained earnings solely for the parent. You see, we did not bring that 375 under ESCO. Okay, we didn't bring it here, rather we brought it here because it was solely for the parent. It is the parent company that has just made an acquisition. They are the ones who own 100% the gain on bargain purchase. So it should only be under parents' retained earnings. It should be an addition to parents' retained earnings. Okay, and unlike in the previous cases where we would have seen goodwill on consolidation as an asset in our consolidated financial position, you see that there is no goodwill here. There is no goodwill. Goodwill is not showing there. Okay, all right. Now let's move on to something else. We have a case here. We're just picking these things to remind us of those things we have learned. Okay. Now, what if the consideration is not only cash? Consideration may also be a deferred or contingent consideration. Now, where this is the case, or should this be the case, what is expected of us is to, first of all, let me differentiate between these two before I move on. Or does somebody in the class want to differentiate between contingent consideration and deferred consideration? Anybody in the class? You can just unmute and quickly tell us. What is the difference between contingent consideration and deferred consideration?
Good evening. Let me try.
Okay.
So deferred is payments that is not being paid immediately, but is going to be paid at a future date. While contingent is reliant on an event happening.
Okay. You've given a very good try. Only one thing. Both of them are future. They are supposed to be futuristic. Both of them are futuristic. The only difference, like you have mentioned, is that contingent consideration, when we say something is contingent, then it means that it is dependent on an event. If an event takes place or if a condition is met, then that liability will now turn into a cash payment. But if it is deferred, it means we are expected to make a future payment. It is not dependent on any event or any condition. Is that understood? However, it is only in terms of definition that they are different. However, in terms of how we are going to treat it, there is no difference between them. Okay, what we should do, what has been prescribed for us to do in this instance is simply for us to calculate the present value of the deferred consideration or contingent consideration, as it were, calculate the present value. Many of us will remember that present value, those of us that are doing SFM, or we have passed SFM, or we did business management and finance at foundation level. Present value will equals the future value, open bracket, 1 plus r raised to power of n, where your PV is present value, FV is future value, R is going to be the discounting rate. And the discounting rate is usually the cost of capital of the parent company. And then N is the number of years. Okay, so you need to do a simple calculation of the present value. Now, when you get the present value, of course, if the future payment is, for instance, this 10,000, if you have to pay 10,000 in December 31st, 2018, and we are consolidating at December 31st, 2017. Now, don't forget that our acquisition date is 1st January 2017. What is the implication of these 3 dates? The first one is the date of acquisition. The second one is the date of consolidation. The third one is the date where we expect to make the payment, the future date we expect to make the payment. Now, when I am going to be calculating my goodwill on consolidation, I'll be doing it at the date of acquisition. It is even the reason why we must lay emphasis on the dates. The dates, you must understand what those dates represent. Now, at the date of acquisition is the date where I'm going to calculate the present value. So in my cancellation of the consideration or investment in subsidiary against the net asset of the subsidiary, the value I'm using is the present value. I'll be using the present value of the future consideration at this date. Now, when I count from January 1st down to the date of consolidation, when I'll be consolidating financial statements, you will discover that a full 1 year, there is a full year in between the date of acquisition and the date of consolidation. Now, I am going to be doing what is called unwinding discount. Unwinding discount. The meaning of this is that as at the date of consolidation, it will remain only 1 year before we get to the full year. Now, unwinding means that I'll be counting the period from the date of acquisition to the date I'll be making the payment. Now, in between the date of acquisition and this date of consolidation, there is a full year. So I need to do what? To unwind the cost. Now, unwinding the cost simply means that I have only recognized at the date of acquisition the present value, which is an amount that is lower than 10,000. But what we are going to pay in the future is 10,000. So I need to take an amount that will represent, I need to take an amount that is going to represent an unwinding of the discount, which will be a current liability. Let us look at this solution because it seems like you may not understand what I'm saying fully, especially if you have forgotten this deferred consideration. Let's do it together. Let's do it together. We're told PICO acquired 75% of the ordinary shares of ESCO on 1st January 2017 when ESCO had retained earnings of 7,500. Now, on that date, PICO made a cash payment of 34,000 naira and a further payment of 10,000 naira on 31st December 2018. If ESCO post-acquisition profits have exceeded any agreed figure by that date. Can somebody tell me, is this 10,000 naira future payment a contingent consideration or a deferred consideration? Somebody in the class.
I feel like it's deferred.
Deferred, okay. Another person? I want to hear from, is it how many, is it 9 of us? Except that's how I know whether you are sleeping or you are in this class. I think there are 7 of us in this class.
Contingent.
Contingent.
Okay, you have changed to contingent. Who else is in this class? Abidemi says contingent. Okay. Okay, if you say contingent, you are correct. Let us move on. Contingent because it is dependent on a particular condition. And what is the condition there? They said if ESCO post-acquisition profits have exceeded an agreed figure by that date. They don't need to tell you the amount, that figure, before you can consolidate, because you're not even consolidating as at 2018, you're only consolidating as at 2017. Okay, let's move on. Although the NCI is measured at proportionate share of the subsidiary's net assets. Okay, given the statement of financial position as at 31st December 2017. Okay, and then we're told to prepare the consolidated statement of financial position of PICO at 31st December 2017. The parent company's cost of capital is 10%. They will always give you, why? Because without the cost of capital, you won't have a discounting rate that you are going to use to calculate the present value. Okay, now go back, let's take it one by one. Let's solve this together. We already know the group structure is such that PICO is 75%. Therefore, there is NCI, non-controlling interest, of 25%. Now let's focus on solving the goodwill. Okay, the goodwill will be purchase consideration, cash is 34,000. Your contingent consideration will be, we're told to discount using 10%. It will be 10% of the future amount. Sorry, let me solve exactly the way I gave you the formula, so that it doesn't look like I am performing magic. Okay, 1 plus R. Remember that your R is 10%, and 10% is the same thing as 0.10. If I add 1 to 0.10, I have 1.10. Now I'm going to count. Don't forget I said you are doing this as at the date of acquisition. Between the date of acquisition, 1st January 2017 and 31st December 2018. Can somebody tell me the number of years, our n, raised to the power of minus n? What is n? What is the number of years that is between 1st January 2017 and 31st December 2018?
2 years.
How many? I didn't hear you
2
clearly.
years.
3
2
years.
years. Yes.
Is it 3 or 2? Which one?
2.
Okay. 2 years. Now, how did we count 2 years? Now, it shouldn't be wrong, or you shouldn't be confused, especially if you are taking advanced tax. Remember, you are going to be doing basis period and you're going to be counting periods a lot. Very easy. From 1st of January 2017 to 31st December 2017 is full 1 year. I mentioned that earlier. And now from this date down to 31st December 2018 is another full year in between. So because it's very easy to say, oh, 2017, 2018, I want to count 1 year. Always take full consideration of which date it is, okay? So -2, all right? Now, if you calculate this on your calculator, what do you get? 10,000, open bracket, 1.10, close bracket, raised to the power of -2. What do you have? Is anybody pressing their now? If you don't have your calculator, if you have what is it called? A trader calculator. Take 1 divided by 1.10. What you get is for the first year. Then to get for the second year, you divide again by 1.1. What do I get? I get 0.82644, blah, 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 blah. Multiply that. Then I multiply that by 10,000. I'm doing my working on my calculator, so you know. I get an amount 8,264.46, blah, 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 blah. I'm only going to take 8,264. Is that the same thing you got?
Yes.
Okay, NCI. We're told NCI is to be measured at proportionate share of subsidiary net assets. Okay, if that be the case, it means we're doing 25% times what is the net asset of ESCO. Net asset of ESCO, the what is it called now? The ordinary share is 25,000, and they add a pre-acquisition retained earnings of 7.5. You add that together, that makes 32.5. Now, 25% of 32.5 times 32.5 gives me 8,125. $8,125. You add all of this together, what do you get? Okay, 50,000. Let's just follow the solution since it's holding me back a bit. You get 8,125, and if you add all of that together, the parent consideration plus NCI, you get 50,389. Okay, you've seen how it was gotten. Now the net asset was 32,500. Is that minus 17,889. Now I'm just going to focus on what was done for unwinding. Now it means that by 2017, this amount, this contingent consideration, is going to be under liability. Yes, is a liability of the parent that it owes the subsidiary. Okay. Then the unwinding, will be a current liability. It means they are going to owe an additional amount which is payable in the next 12 months. So I'll treat it as current liability. That unwinding, look at how it was done. We'll say what is the cost of capital multiplied by the present value of the contingent consideration. That was what they did here. Sorry. That was what they did here. 10% of the 8,264. And now, what do we do with this? Okay. I said this 8,264 will be treated as a liability, right? In your consolidated statement, it didn't show up before, it's now going to show. This 826.4, you're going to debit. It is going to be treated as a finance cost. If it's treated as a finance cost, that's P or L. Abi? Now, we are not treating P or L here, we are treating financial position. So I've always said, anytime that is the case, any adjustment that should be in the P or L, when you are treating financial position, you will simply say to yourself, what is the line on the financial position that represents the P or L? It is the retained earnings. So I would say debit group retained earnings. All right. And then I'll credit current liabilities. Okay. I'm sure that is what they were explaining there. Okay. Contingent liability, if you like, it's a finance cost. And now what that means is that the total liability put together will be the one at acquisition date and this finance cost for the year 2017. Okay. And that is just the treatment that you have there. If you look at consolidated retained earnings, you see that 826 solely under PICO because it is PICO that owes that amount. And it is PICO that should bear all of that finance cost. Okay. Now, what about if the consideration is neither contingent nor deferred consideration, but it is a share exchange? I believe this one is very simple. You have a case whereby rather than make a cash payment, the parent has decided that they are going to issue its own shares in exchange for that of the subsidiary. Of course, they will either be issuing more or their own shares is valued more. So let's look at how that works, how that pans out. Look at the problem. They said PICO acquired 75% of the ordinary shares of ESCO by issuing 5 of its own 1 naira shares for every 3 naira shares in ESCO on 1st January 2017, when ESCO had retained earnings of 7,500. The market value of the parent company's shares is 5 naira. NCI is measured at proportionate share of subsidiary net assets. And then we're given the statement of financial position. I'm just going to show you, there's no big deal to this one. We're just going to see how this was calculated. Now, mind you, be very careful. You will notice that in the books of PICO, very important, in the books of PICO, we have 50,000 ordinary shares of 1 naira each. Okay? But we were given the market price, the market value of the parent company shares at 5 naira, meaning that I am going to have a mismatch when I look at it. 5 naira market value, 1 naira book value. Very simple. It means that there is going to be share premium. Okay. But first of all, let's see how we're going to calculate the value of these shares. Okay. Look at what was done here. You will see that the shares of the parent for 5 for every 3, and this is how I normally call it out and calculate at the same time. I like to say it as I'm writing, especially inside the exam halls. I'll say 5 for every 3 of 75% out of 25,000 shares, meaning that this number of shares is what PICO will give in exchange. Okay, PICO will give this number of shares in exchange for acquiring Abi. Now, this is what their holding is, but this is what they are exchanging for 5/3. They are this calculation would give you 31,250 shares. But we're told that the price, the market value of these shares is 5 naira each. So you multiply this by 5 and you get an amount 156,250. Now, what I was discussing the other time was the fact that this 1,250 represents the amount of the shares at 5 naira. Don't forget that in the books, the book value is only 1 naira. So when I'm going to represent the ordinary shares should be 1 naira multiplied by 31,250. The remaining 4 naira will be share premium. Let's not forget this. The remaining 4 naira would be share premium. Now let's look at how they calculated goodwill. Okay, all of the 156,250 will be taken as investment in subsidiary. No problem. No problem. Okay, let's see the goodwill calculation. You see, goodwill calculation, transferred consideration is still 156,250. Non-controlling interest, the way we normally do, they said it is proportionate share, right? And then we'll go through all of that, the same thing we've always been doing. But when you come to the consolidated financial position, you see, that 31,250 was an addition to the ordinary shares of the parents, whilst the remaining 4 naira times 31,250, 125,000 naira, showed up as share premium. It showed up as share premium. This is the difference between when there is share exchange and when cash payment is made. Those shares that were issued will increase the ordinary share capital of the parent, and if the market price is higher than the book value, you are going to have the share premium. Okay, so what you just need to pay attention to is what is the book price or the book value and what is the market value in most questions, because that is what is consistent with reality. Consistent with reality, what is it called? The market price will usually be higher than the book value. The market value will usually be higher than the book value. So you have what is called share premium. Let's move forward. Now let's see a variant of different consolidation adjustments put together. Let's see a variant of this one. As I'm reading, I'm going to be asking us, what is the adjustment that we will do? Are we ready? Let's go. The statement of financial position of PICO and ESCO as at 31st December 2017 were as follows. Given the PICO numbers and the ESCO numbers, and then we have additional information. which is a little bit more than what we have been dealing with. We have been dealing with special cases before. Now we have a combination of a number of things put together. So let's look at it. We're told PICO acquired its investment in ESCO on 1st January 2017, when the retained earnings of ESCO stood at 3,000 naira. Okay, this is the first thing to note. Pre-acquisition retained earnings was 3,000 naira. Okay, now the agreed consideration was 15,000 naira cash and a further 5,000 naira on 31st December 2018. PICO's cost of capital is 8%. Can somebody summarize how you are supposed to adjust this, how you are supposed to treat this? There's a deferred consideration of 5,000 naira and the parent's cost of capital is 8%. Anybody in the class? Anybody in the class? I'll call Nemo. Praise.
So I think the 5,000 would be unwinded. So it would be 5,000 into brackets 1 plus 8% raised per minus 2.
Raised to power of -2. Okay.
Yes. And then any figure we get there, we get the interest portion, which we put in the finance cost.
How do we get the interest portion?
We just apply the percentage on the amounts we get after unwinding.
On the present value. Okay. Yes. All right. It is when we do that we have now begun yearly unwinding. Thank you very much. Thank you. That's correct. Absolutely correct. Okay, let's move on. ESCO has internally developed brand name, which was valued at 2,500 naira at the date of acquisition. What are we going to do about this? Anybody? What's the adjustment we'll do for this one? Okay, I may have to call name again. Abidemi. Is she still in class? Abidemi, are you with us?
Yes, I'm here, but I wasn't paying attention, but let me just read it again. Sorry.
Okay.
I think this is a goodwill. It's goodwill, and I think it's revaluation of goodwill at the date of acquisition.
It's not goodwill, it's brand name. It's brand name. Yes.
Which was valued at
2.5. Okay. Okay. Let somebody else try. Cyril Olusoji. Is he with us? Okay, how about Kelvin? Want to try?
Okay, sir. Sir, what's the question?
Have you been following us at all? Okay, they said ESCO, the subsidiary, has an internally developed brand name, which was valued at 2,500 at the date of acquisition.
Okay. So, I meant to say how it's meant to be treated.
Yes, you might just give us either you can tell us the procedure, or you can just tell us the double entry. Whichever one you want to do is fine.
Okay. So for this brand name, it will be added to the retained earnings. That's debits retained earnings of the parents and credits the um intangible assets.
Okay, we've not done this before. Let me just pick one more person. I like to hear your views. Uzeni.
Yes, sir. Well, let me just, I don't have any idea to ask simply because I came into the class late. I just come back from work. Please,
Yeah, sorry.
I create the intelligence, please.
Okay. Is Praise still with us? Praise, you want to try? Praise, is she still with us?
I think it will be part of the assets. So it would be debited as part of the assets. I'm not so sure.
All right. Okay. Now, if ESCO at the point of acquisition, at that particular date, at the date of acquisition, you are not seeing the brand name in their books, right? The reason for that, of course, you won't see brand name. It will not pass a particular test under IAS 38, which is that at that point, we will say it cannot be traded in a separate transaction. So it is not monetary, all right? But at acquisition date, if ESCO is able to say, we have internally developed a brand name and PICO is supposed to pay for it, and PICO has agreed to pay for it, then it will pass that test, all right? It means that it will now show up in the consolidated financial statement as an asset. The brand name will show up as an asset. Now, the second place to show up is that when we are canceling out the investment in subsidiary against the net asset acquired, that brand name will feature as part of the net asset of the subsidiary. Is this understood?
Yes, sir.
Is this understood?
Sir, please come again.
Okay, thank you, Kelvin. What I'm saying is this. You see, this internally created showed up in the asset, if you look, it's not even to not have. If you look at the question, let me go back. Now, look at ESCO. Look at their asset side. Did you see brand name there? It's not going to show. It's not going to show there. In the separate books of ESCO, you won't find brand name. It's simple. It's taking you back to IS 38, which covers intangible assets. Now, it will not show because it will not pass a particular test, which is that it cannot be traded in a separate transaction. Any asset, any intangible asset that we cannot prove that it can be traded in a separate transaction will not come in as an asset. It will not be recognized. You're not going to recognize an asset. Okay? Now, if that be the case, when it is time for PICO wanted to acquire ESCO. ESCO now brought up this brand name matter and say, we have internally developed a brand name and we are going to value it at 2.5 million or 2,500 naira at that date. And PICO agrees to pay that 2.5 million naira. What it means is that you are now going to recognize that intangible asset because it has now been traded in a separate transaction. Now, the transaction it was traded in is on acquisition, Abi. So therefore, you will treat it like this. You will say, when I am cancelling out the investment in subsidiary against the net assets of ESCO, I am going to consider this brand name because it is part of what I have paid for. Is that clear?
Yes, sir. Yes, sir.
Yeah.
Now, also, because you have paid for that asset and it is an intangible asset, and we have traded it in a separate area, as much as it will not show in the separate books, when we are consolidating, it will show as an asset. Because it is on consolidation that it was traded as a separate item. So therefore, it will show up on the consolidated financial position as an asset. Okay? If that is clear, I will move on. There have been no changes in the share capital or revaluation surplus of ESCO since that date. Okay? Okay, what's the implication of this? It simply means that there have been no changes. ESCO ordinary shares remain the same. Their revaluation surplus has also remained the same because you can see revaluation surplus there. It simply means that there is no post-acquisition retained, post-acquisition revaluation surplus. So there will be nothing to share. But I have said it is a simple rule. What will be shared is post-acquisition. And there will be zero there for ESCO. Okay? They have been, at 31st December 2017, okay, good. ESCO had invoiced PICO for goods to the value of 1,000 naira, and PICO has sent payment in full. But these had not been received by ESCO. Okay, I want somebody to summarize what you're going to do. Yeah, what are you going to do? Okay, you still want me to call name? Okay, if you ask me to call him, I will call. I am your servant. Kelvin.
Yes, sir.
How would you treat this?
Yes, sir. Can't hear you, sir.
You can't hear me?
Barely, sir.
I said, how would you treat this transaction this money that Pico has sent that ESCO had not received, how would you treat it?
Okay. Pico sent like. So I'm not seeing your screen.
Okay. And
Like
that's
the
stop
part.
sharing.
No, like the part of to see the amount. Okay. So ESCO had invoiced Pico for goods to the value of 1,000, and Pico had sent payment in full, but this has not been received by ESCO. So I think that how we are going to treat this transaction is we are going to,
Me too.
okay, so intragroup sales is meant to cancel out. So we are going to debit since ESCO is the seller, we are going to debit that's like reduce the value of the goods from ESCO's profits, and also debit Pico. So I don't know. So I don't know, sir.
Kelvin, you've tried. Anybody else? I think we mentioned this last week. Let me see. Who else should I call? Who else should I call? KYAWA. I don't know the right pronunciation. That's why I'm spelling. Is it Kyawa or Kiawa?
It's Kiawa.
Kiawa. Okay, thank you. How would you treat this?
Sorry, which one? I stepped out. I just go back.
Okay. We're told. Let me annotate so that you can see where my reference is. So we're told at 31st December 2017 that ESCO had invoiced Pico for goods to the value of 1,000 naira, and Pico has sent payment in full, but this had not been received by ESCO.
Okay, that's intergroup trading. Value goods 1,000. They had sent the invoice. So that means if they have not received the payment, it will be in their receivables. We'll take out this value from receivables. They had made the payment, and I think the other part will be net out from bank, will be added back to bank, because I know we're supposed to cancel out intergroup trading.
Of course.
Well, I'm sure of the 1,000 will be in the receivable for SCO. It wouldn't be in payables for for PCO. It won't be in payables for PCO since they've already made the payment. So it's bank. Either we'll add it. Sorry.
Oh, go ahead.
I know we're canceling out. We're going to cancel out 1,000 from receivables for PCO. I think to balance that, I might need to put it back to bank for SDO.
You have tried. Please, let me pronounce your name again. Sorry.
It's Kiawa, like
Kiawa.
Kia, like Kia, Kia Motors, and then Kiawa.
Thank you. You really tried for me. You've helped me. So when next I want to call your name now, I know how to call your name.
You can also just call me K. I'm fine with K.
There are many keys.
I'm fine with K.
All right. Thank you very much, Kiama. To an extent, you're correct, but I want us to pay attention to this. Let me help us. What are we supposed to pay attention to? On current assets of PICO, you will see, I said PICO, of ESCO, you will see owned by PICO, 5,000. Let me underline that for us. You see the 5,000, sorry. I want to underline. 5,000, Abby. And then when you look at current liabilities, for PICO, you see owed to ESCO. This is where the 1,000 is coming from. The 1,000 is not a big deal. Even if they had not mentioned it, it will still have been something to consider. You know why? The current liability means that PICO owes ESCO. The original amount was 5,000. PICO is only recognizing 4,000. You know why? Because they had made a payment of 1,000. Although in PICO record, it is still 5,000 because they have not received the money. It will not stop me from canceling 4,000 against 4,000 here. The remaining 1,000, I told you in the last class, we'll refer to it as cash in transit. It is because of this reason that it will form part of my consolidation, because in the book of ESCO, this 1,000 naira has not yet been settled. So it will still show in my consolidated statement of financial position, but it will be under a line called cash in transit. Okay. That's that about that. Let's move on. So let's look at the last thing there. It said it is a group policy to value NCI at full value. At the acquisition date, NCI was valued at 9,000. Okay. Now, if at acquisition date you have been told, now what we have been used to is that we're going to be giving the market price of the shares of the subsidiary company, which we'll now use to calculate the NCI. But they said, don't worry, we are going to be nice to you. We have already given you the value of NCI at acquisition date, 9,000. How do we go about this? All right. How do we go about this? A number of things are here. We'll pick them one by one. And like I always say, the first thing to figure out, very important, so that you don't forget, is to consider what is the group structure. The group structure in this case is that when we share ESCO, we'll share ESCO into 75% for PICO and 25% for NCI. Okay. After we've done this, we want to determine what is the goodwill. Okay. Look at how we're going to do goodwill. Our purchase consideration will be split into two: an amount for cash payments, an amount as our deferred consideration, a deferred liability. Okay. The cash amount that we are making as payment is down here, 15,000. Okay, let's just come to the solution. It's 15,000. Let's go to the goodwill calculation. Purchase consideration amount cash 15,000. Okay. Deferred consideration 4,287. Okay. And then we have NCI. We have been told NCI is valued at 9,000. That totals 28,287. Okay. Now, when I'm looking at the net assets acquired, we have been told there is ordinary share capital, according to the question, 12,005. There's a pre-acquisition retained earnings of 3,000. Okay. Revaluation surplus at that date was 25. Remember, they told us what they were implying here. They wanted you to know that this revaluation surplus that you are seeing in the book of ESCO is pre-acquisition. This was why they told you that since the acquisition, pay attention to this part. Let me take away all my notations. You know, we read it and we left it. We read it briefly and then we left. It said there have been no changes in the share capital and revaluation surplus since that date. So it means that what I am seeing here under ESCO as revaluation surplus of 2,500 did not come after acquisition. It was there already at the date of acquisition, and it has remained the same. So that is why I am treating the whole of that 25 as revaluation surplus. Is that clear? Pre-acquisition retained surplus. I mean, revaluation surplus. Is that clear? Is it clear to us? Is it clear to us? If it's not clear, let me know.
We are following.
Okay, good. Okay, and then you will see brand name show up. This brand name is showing up as well. Like I mentioned, it is part of the net asset that was acquired. So therefore, it is going to show up on your consolidated. It will never show as a separate line item under assets in the book of ESCO, but it will show up in your consolidated statement of financial position. I have told you why already. Okay, so we get our goodwill here. Fine. But don't forget that we still need to unwind the discount. I mean, now in unwinding the discount, we'll say what is the cost of capital multiplied by the contingent or deferred liability. Multiplied by the deferred liability. So it is 8% multiplied by, when they did the calculation here, I'm sure they would have done, if you do 5,000, open bracket, 1.08, because it is 1 plus 8%, raised to power of -2, I'm sure you would have an amount to 4,287. So if you do 8% of 4,287, this will be your finance cost for that year, okay? And it's an amount 342.9, which we're going to say 343, okay? Now, don't forget how you're going to treat this. This will, what did you say?
I have a question, please.
Go ahead.
For the contingent and deferred consideration, are there same treatment?
Are there same treatment? Yeah. I mentioned that. Okay, you're asking if the treatment for deferred consideration and contingent consideration if they are the same, right?
I noticed that the last time we did was contingent, and we
Yes,
treated it the same way, and now we have deferred, and you're treating it the same way.
yes, it's the same way. We're going to treat it the same way. It's the same, absolutely the same way. They are different in their definition, but they are not different in how we are going to treat it. And the simple reason for that is even if it were to be contingent, meaning that you need a condition to be met before that liability will now crystallize into cash payment. What you are still going to do in your book is to recognize a liability. Do you get that? Even if it is contingent, you will still recognize a liability. I believe I'm the one who is going to take you IAS 37. We're going to do that under IAS 37. So if, for instance, your company ABC Co. entered into an agreement with another company, let's say Abeco, and one of the articles of that contract, one of the line of that contract is that you're going to pay Abeco 5,000 naira if Abeco is able to make a profit of 2,000 naira now at a future date. It is true that Abeco has not made 2,000 naira profit. It is true that that future date has not come. But because we can tell as of today and we can measure what your liability will be in the future, if that event was to take place, then what we will do is that we're going to recognize a liability in our books, in the book of ABC Co. Now, at that future date, if that condition had not been met, then we're now going to reverse that liability. You must have expensed up until that date. So all the things that you've expensed and the liability, you are going to reverse. Does that make sense?
Yes, please.
So it's just still back to, we spoke, was it this class we spoke about prudence? Oh, maybe not this class. An accountant will work in such a way that you never at any point in time want to overstate your income or overstate your asset. But if we are in any way going to be liable for anything, if it is probable, then we'll recognize. If we are going to have to incur an expense, once we can measure what that expense is or whatsoever, you will see the accountant will tip towards more recognizing that, because it will reduce because if we don't do it and there is such a transaction that can trigger at a future date, what you have done is you have not given a fair representation of the financial activity of your company. You understand? You've not given a fair. Okay, let's move on. So now this finance cost will be represented normally on the profit or loss, but because we are dealing with financial position, I said you will take it to group retained earnings and you will immediately recognize a liability for the group because it's that of the parent company. Okay? And that is that on deferred consideration. Okay? Now, on the aspect of the other adjustments, I think those ones are quite straightforward. You can take your time to look at this solution and see how it was treated. Is there anything else worthy of mention? I think I'll just move on so that we can round up on simple consolidation of financial positions. today. I want us to finish it today. Okay? Intra-group trading. Now, you see, we have been dealing with two things. We have been combining or adding up like items, line by line, Abi, in consolidation. And I went on to say the second thing to do is cancellation of any transaction that has taken place between the parent and the subsidiary. Now, we have seen that those kind of transactions take place in the form of a current asset in the book of either of them and a current liability in the book of either of them, and this transaction is between the two of them. I mean, between the parent and the subsidiary, like the case of the 4,000 that I just canceled out. You see it in the current asset, you see it in the, but the one we want to treat now is a case whereby, you see, there is a transaction between parent and subsidiary where subsidiary are sold. Subsidiary sold to parents. Subsidiary sold to parents at an amount that is higher than cost, meaning that they sold at profit. They sold at an amount where they are going to realize profit. Okay? Now, these goods that they sold to Pico is still having some of it in their inventory. Pico still has it where? In the inventory, meaning that as at the date we want to consolidate, ESCO has an unrealized profit. We will treat it as unrealized. You know why? Because we believe that this Pico and ESCO in our consolidation, they will be treated as one company. So you cannot make profit off yourself. So therefore, this profit would take it as what? Unrealized profit. And this inventory is still in the book of Pico. This goods is still in the inventory of Pico as at the date of consolidation. What are we going to do? We are going to need to cancel out this unrealized profit. How do we do that? You know, it's still under inventory. So when we are consolidating, we will not consolidate this item of inventory that Pico bought from ESCO. We will credit inventory, all right? Because we are going to minus from the inventory that amount. Okay. We're going to debit group retained earnings, meaning that we are canceling out that unrealized profit. Okay. Now, because it is not only the parent that owns ESCO, NCI too. Did I say credit? Sorry. Debits NCI. Why are we debiting NCI? Because we are assuming that this unrealized profit, this group structure is such that there is a parent and there's an NCI. So if, for instance, parent owns 75%, then parent will suffer, the parent will take back 75% of ESCO's unrealized profit from the parent on consolidation. That's what I mean. And then the remaining 25% will adjust our NCI. Let's look at it. These are things that you did in FR. We're just revising them, remember? So let's see, it's one of the challenging areas that a lot of students used to have in FR. So let's take our time to look at it considerably well. Can see the group entry, the double entry that was referenced here. I believe you can see it. Debit group retained earnings, debit NCI, credit group inventory. They call it group inventory because it is on consolidation. This inventory should be the addition of PICO inventory and addition of ESCO inventory. However, there is a portion of PICO inventory that was sold by ESCO to PICO, and there is a profit element. PICO is taking it at cost, but there is an unrealized profit element there that we need to cancel out, and that is what we are effectively doing with this double entry here. Okay, let's move on. Okay, problem one, intergroup profit. We're told PICO owned 75% of the shares of ESCO since the incorporation of ESCO. During the year to 31st December 2017, ESCO sold goods costing 8,000 naira to PICO at a price of 10,000 naira. You can already see that ESCO would have recognized profit of 2,000 naira. All right? And these goods were still unsold by PICO at the end of the year. Now, the statement of financial position of the two companies on 31st December 2017 are given below. All right. You're required to prepare the consolidated statement of financial position of PICO at 31st December 2017. All right. The fair value of the NCI at acquisition is 12,500. Okay. What I just want to show you here is how we're going to treat this 2,000 naira. Okay. Let's look at how we'll treat it. How did we come about 2,000 naira in the first place? Very easy. If ESCO sold goods costing 8,000 naira, 10,000 naira, then they must have made a profit. This is an intra-group profit. 10,000 minus 8,000 gives me 2,000. Now, this 2,000 will be split 75%, which is an amount 1,500 belonging to PICO, because that's the element of group. Don't let me even call it PICO, let me call it group. We're going to take this from the group retained earnings, and then the remaining 25%, an amount 500 naira, we're going to take this away from NCI. Now, the retained earnings and NCI are both equity components. So to reduce these values, equity is credit. Abi, to reduce it, what do? I debit group retained earnings 15, debit NCI 500, and then to reduce these goods that must be showing in the book of the PICO at 2,000 naira, we want to reduce that inventory 2,000 naira. We'll reduce inventory by crediting inventory 2,000 naira. See, that's what we're going to do. So when I'm treating the consolidated retained earnings, we are going to see this 15 show. Okay, let's look at how they did group retained earnings. Okay, you see that unrealized, they didn't split it into 15 and 500. I have told you the reason. It's an adjustment that affects both the parent and NCI. That is why. If I like, I may decide to split it separately. I'll simply say 75,000. I will share all of this 30,000 as consolidation date, the retained earnings, the post-acquisition retained earnings of ESCO. If we take 75% of this 30,000, that should be an amount 3/4 times that. How much is that, please? Somebody help me. 75% of 30,000. Is that not 22.5? Okay. 22.5. All right. And then we'll take away 75% of 2,000, which is 1.5. And this will still give me
22,500.
Okay. If I take away 1.5 from 22,500, I should have 21. If I add that 21 to 75, I have 96,000, which is still the same 96,000 they have here. If I do my NCI and I say NCI at acquisition date 12/5, and then I say I share this 25% of 30,000 to NCI, I should have 7.5. Share of ESCO retained earnings. And then I say, oh, unrealized profit, the share of unrealized profit will be 25% of 2,000, an amount 500 naira that we mentioned the other time. If I deduct that, that will be 7,000 plus 12.5, making 19.5. It is still that same 19.5 you have here. However, I have told you there's no point doing all of that if it is an amount that affects consolidated retained earnings, and it's supposed to affect both PICO and NCI. Just do that deduction at once under ESCO. You won't need to be doing too much calculation that way. Okay? I want to ask, is this understood before I move forward? Do we understand? Can I move forward? I'm not hearing us, so we can use the chat box as well.
We can move on, sir. We understand how you use the percentage on the group and the NCI, but only that the second calculation they show, though I didn't start with you from beginning. That's why I didn't understand. But I understood how you take the 75% of the parent and 25 from the 2,000 to share,
Okay.
and also credit the inventory.
Okay. All right, let's move on. Let's see another problem here. We're told PICO acquired 80% of the shares of ESCO on 1st January 2017, when the retained earnings of ESCO stood at 5,000. The statement of financial position of the companies on 31st December 2017 are given as follows. During the year, ESCO sold goods to PICO for 25,000, the profit to ESCO being 20% of selling price. At the date of report, at the end of the reporting period, 7,500 of the goods remained unsold. Okay. At the same time, PICO owed 6,000. Okay, I'm not going to bother about this other intra-group trading. We've dealt with that one, the one of 6,000. If you look at the book of PICO, okay, they didn't make special mention, but no problem. How do we treat that 6,000? It's very simple. We'll remove that 6,000. We'll cancel it from the current assets of, who did they say, but PICO owed ESCO, okay? we cancel it out from the current asset of ESCO, remove 6,000 from that 15,000 before we add 20,000. And the current liabilities of PICO, we remove 6,000 from that 10,500 before we add to that 9,000. That one is straightforward, okay? Now, even this second problem is still similar to what we have. The only thing here is this. It is only 7,500 naira of these goods remained unsold at the date we are consolidating. Are you with me? So the unrealized profit will be limited to 20% of this 7,500. And that should be how much? 7,500 divided by 5, that's 1,500. So it is this 1,500 that I'm now going to split between 80% and 20%, meaning that we'll be debiting group retained earnings. How much? 80% of 1,500, which should be an amount 1,200. And then we debit NCI, 20% of 1,500, which should be an amount 300 naira. And then we credit inventory, 1,500. Okay? Is that understood?
Yes, sir.
There's only one person that is answering.
I thought the one you debit, that's for the group and the NCI, was dependent on who is selling, whether the parent or the NCI, or determine where we adjust for it.
Yes, you are right. The consideration is that ESCO, even this question, this problem too, ESCO sold goods to PICO. Is it understood now?
It's just the NCI, not the group retained earning.
What did you say?
It's affecting just the NCI's retained earning.
No,
Since
not just the
sold,
NCI. Okay, let us analyze like this. Who sold? ESCO sold. Abi?
Yes.
ESCO
Yes.
is owned by who? ESCO is owned by who?
PICO.
PICO and who?
And ESCO.
And NCI.
Okay.
And NCI. Okay, do you understand now? So if
Yeah.
ESCO will be making a profit of this transaction, this remaining unsold inventory, 20% of it is 1,500. It is this 1,500 that we are going to treat as unrealized profit. Now, who owns this profit? This profit is owned by ESCO. Therefore, my treatment of this unrealized profit must affect both PICO and NCI. Is it clear?
All right. Yes, sir.
Now, I understand the scenario you may want to build is like this. If PICO are sold to ESCO, it's a much simple situation. You know why? Because it is PICO that has the unrealized profit. So this one, nothing will concern NCI. It no concern NCI at all. Non-controlling interest will say, I am not a party to that transaction simply because that profit is a profit that was solely made by PICO, and NCI does not have any investment in PICO. It has investment in ESCO. It is the unrealized profit that we are taking back for ESCO that can affect NCI. Is that clear?
Yeah.
All right. Okay. Don't worry. I want us to move, but it is also good that we are revisiting these concepts. It will help us a lot when we slide into complex. Okay. I have only one agenda left for financial position. Only one agenda left, which is group sale of non-current assets. Non-current assets. What if what we traded is not an item of inventory? Instead, it is non-current asset. It's the same idea. Do we have a profit on disposal? Any such profit on disposal will be treated as unrealized profit. Now, if the sale is by the parent, it's still the same logic. NCI will have no share in this adjustment. They will absolutely have no share there. Why? Because it is the parent that has made this unrealized profit. But when the sale is by the subsidiary, okay, both PICO and NCI own the subsidiary. So therefore, any unrealized profit that ESCO has made will be shared between the group retained earnings and the NCI. And then we'll go and remove such non-current assets from our consolidation. We'll cancel it out by crediting the non-current assets. Okay. Now, there's a note here that says, since the non-current asset was recognized at the profit loading, it would have affected the depreciation on the non-current asset. So the excess depreciation must also be eliminated. And the double entry for that would debit non-current assets and credit retained earnings. Okay. What we are saying here is this. We are trying to trigger a situation. What would have been done when calculating the profit on disposal is this. If you still remember our basic FA, I'm coming, just a moment. What would have been done is this. You would have said, I'm going to take the, sorry, I'm coming. All right. For us to realize profit, we would have treated both costs and accrued depreciation. All right. We have a carrying amount. Okay. Now, what we received for disposal, we are going to take the carrying amount away from it to determine whether we have made a profit or loss on disposal. Abi? So in effect, when we are taking this as an unrealized gain, and we are taking it back, we are saying on consolidation, this will not matter. We also would have taken part of the depreciation into consideration here. That depreciation also needs to be returned. Let's look at it. So that the demonstration will explain it. Okay, let's just look at a scenario. We are told Pico acquired 80% of the shares of ESCO on first. This is going to be the last. I'm coming. I just want to check. I think this would be the last. Okay, there's still acquisition during the year. Fair value adjustments. You know what, just manage with me. Just let me explain this, and then we can quickly look at the rest. Don't sleep on me and don't leave the class, okay? I know you're tired. Let's do this together. We're almost done. All right. We are told Pico acquired 80% of the shares of ESCO on January 1, 2016, when the retained earnings of ESCO stood at 5,000. The statement of financial position of these two companies on 31st December 2017 are given below. Okay. On 1st January 2017, ESCO sold plants costing 5,000 to Pico for 6,250. The group charged a depreciation 10% on all non-current assets. NCI is valued at 9,000. You see, let me take you to where we treated that. This intragroup profit. Okay, we received an amount 625. This 5,000 is the cost. Abi, we made intergroup profit of 1,250. All right. Now, how do we treat this unrealized profit? Since it is the subsidiary that sold, so it is the subsidiary that owns the unrealized profit. You see how it is shared 80%, 20% of 1,250. Abi? Now, we are told that there is a policy from the group, they do 10% of course. Abi? In this case, there is an element of depreciation inside your unrealized profit. There is an element of depreciation, which is 125. Now, you will not write back all of the profit. You must take back this 125. So in taking it back, what do? We debit the non-current assets, and then we credit the group retained earnings. Is this clear? Is it clear to us?
Yes, sir, we understand it.
Okay. Now, when we come to acquisition of a subsidiary during the year, there's no big deal to this. There's no big deal, no particular big deal to it. The only thing we have always said is that pay attention to what is the part of the retained earnings that both the parent and the NCI will share. It is only the post-acquisition retained earnings. Okay? So if an acquisition was done in between the year, it is still the same logic I'm going to apply. When I am sharing the profit, okay? Look at it. It means whatever profit that the subsidiary made in that year, we are going to share into two. A certain portion before the acquisition date will still be pre-acquisition retained earnings. So I must find a way to share. So let's say, for instance, profit for the year in this instance is 12,000. Okay. acquisition was April 1, right? It means that everything, if the accounting year is January 1 to December 31st, what they had realized from January 1 to March 31st should be pre-acquisition retained earnings. Now, if the examiner is quiet on how you are going to share, you just assume that this 12,000 was evenly made throughout the year. And what that means is that I will say 12,000 that was made over the year each month, because there are 12 months in a year, we must have realized 1,000 naira profit per month. For these 3 months, January, February, and March, pre-acquisition profit for that year would be 3,000. Okay? Then it is this 9,000 that is our that is our post-acquisition retained earnings. That is what we're going to share. That is what you must pay attention to around there. It's not anything special. It's not anything special. I know during FR, students usually have a bit of problem around here as well. So what do we do in the next class? What we would simply do in the next class is take a past question, a solid past question, we'll solve together. Fair value adjustments, we mentioned adjustments already. I'm not going to beat the bush around fair value adjustments again. I think we'll just end it here. Do we have any questions so far? We'll end it here. In the next class, we'll solve a past question, a good past question. That will be the first thing I'll start the class with. Once we do that, we'll talk about what is it called? Investment in associates. There's no big deal to that as well. It's just equity method you want to learn there. And if there is what is it called? Intra-group profit and all of that, how do you treat the case of investment in associates? So next week we'll start. We have delayed it a bit because I wanted us to go through all of this. It's better that we go through it together than I am assuming that you have done it before in FR. Okay? All right. So we'll end it here. Is there any question for me? Is there any question? Any question?